Welcome to the Dividend Talk podcast, episode 39. Why did EMF sell Coca Cola? Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you are new to this channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Good evening, European DJI. How are you on this Friday evening?
Like always, a busy week behind me, but I was actually really looking forward for the show today. I know we're both busy today, but this is really one of those evenings always to look forward to. I know our wives are probably less happy, but hey, this is what we do for the community, right?
It's
So
a
I'm
small
really happy.
sacrifice that we make, isn't it? I mean,
Exactly.
I'm happy. I've got 5 days off from work. I took Monday and Tuesday off, and we've got St. Patrick's Day. I don't know if you celebrate that over in your
No,
part of Europe, but
no.
it's an Irish kind of holy day. St. Patrick came and got rid of all the snakes, and now he's a saint. And we dress up in green and march around in his honor, drink Guinness. So we get a day off of work, which is good. There'll be no parades around this year, but we'll still take the holiday and just relax.
Cool. What will you be doing then with your free time? Writing a nice article or something like that?
Yeah, I have a couple of things on my list. I don't know if I've mentioned here before, but I've started freelance writing for a popular newsletter. So I have a couple of articles to catch up with on that. And I might write about Pepsi as well, because I know we're speaking about Coca Cola today and why I sold them. But I want to analyze Pepsi because that's another kind of popular one that's out there. And I have a small bit in my portfolio. So I just want to cover some ground on them. So that's what's in store for me this week.
Nice, that's nice. So, but it was a crazy week actually this week. If you look at all the news that we saw, and I think you had a nice news item from Verizon, I believe.
Yeah, this kind of popped out because I've seen that you posted on Twitter a comparison between AT&T and Verizon. And if I'm correct now, correct me if I'm wrong, but you were surprised that Verizon actually had more debt
Yeah.
than T. So this week then they've went out and they have issued some bonds or stocks for sale, and they did quite well. I think they've done better than what was expected. There was about 100 billion worth of orders that went into this. Now that doesn't tell the full story. That doesn't mean they've got 100 billion, but it was quite positive to see that there was a huge demand for their bond.
Yeah, and they are quite in transition, right? In the sense of also 5G there, and the auction that was going on. So they need all the cash. And actually, today I watched a little bit and oriented a little bit around AT&T because Stanky was on CNBC. And also there, if you heard them talking about 5G, he said something really interesting. If you think about, for instance, the questions we were asking ourselves about at the time 10 years ago about LTE, they are quite similar as now to 5G.
Yeah.
And he really sparked my mind in the sense of imagine what you could do with 5G. I mean, because of course I know all this stuff in general, but he mentioned, for instance, ride sharing requires really LTE, right? And we would have never predicted that ride sharing would kick off. So maybe really a bit daydreaming about what could 5G actually do to the creativity in the world again.
Yeah. And just going back to Verizon at the moment, I found it really interesting that they've chose to sell bonds at the moment, or to put out their bonds, because I know they could have easily just issued more shares and they may have got the money that way. But I was wondering, and I'm going to put you on the hop a little bit. Why would they go down that route instead of taking out a loan from a bank, considering we're still in kind of a low interest environment?
Um, I think, how you said, I believe, and I'm not sure, but I think the bank has the first rights on a claim
Yeah.
once something goes wrong with the company.
Hmm.
I guess with bonds, you can easily, I guess, I,
Something just fell off the chair behind me.
so I guess with bonds you can, in theory, if you would default on that, but it would still be bad for the company. Yeah,
Yeah.
so you would still go bankrupt. So, it's usually also, for instance, with a bank you have certain policies, and with the bonds you set them more yourself. You decide on your rent kind of yourself, the interest rate. So, I guess it gives you the flexibility.
Yeah. Yeah. Cool. I believe you have some news on a company that you cannot invest in. It's British American Tobacco, I think, is it?
Yeah. What I found really interesting is, when I wrote my blog post about it a while ago, I was mentioning about, business opportunities as such, and then what is it? Their product, I think it's called Glow, in an FDA approval. But
Yeah.
they caught me a bit by surprise this week, because they took a stake in a marijuana company, and I think the name is called Organigram, and they took a 20% stake in there. And 20% stake means really that you're a majority shareholder. And for me, that's usually a sign that maybe in the upcoming 1-2 years they might take over the whole business, right? It's kind of I said, a dedication stake, as I call that. So I found really interesting. It's not as big as the investment that Altria did in the marijuana space. It's really interesting to see that British American Tobacco is diversifying a little bit away from pure tobacco and also went into marijuana. And yeah, I found it really interesting, because I'm wondering if we will see more of these kinds of consolidations in the tobacco space, because the old style cigarette is just out, I said, out of favor by regulatories, by also the population. So I really wonder if this will allow them to go into a less controversial space. Let's call it like that.
Yeah. Like you can imagine when the marijuana space does take off. I know it's been, I don't know a whole lot about it, but I know in parts of America it's been legalized, and there's lots of movements involved around it. But you can imagine when it does take off, it's going to be huge all over the world. So I'm kind of happy to see move in a little bit to this space. A 20% stake is kind of like a promise ring, isn't it? It's kind of
Yeah,
like a promise to marry you if things go well, and they're just kind of feeding out the market. So it's a wise move for them, and I'm interested to see how that goes. I did actually want to have a little bit of exposure in that space, and I know Wolf of Harcourt Street has one of these REITs that I keep saying that I'm going to look at, and I just never have. So finally, one of my companies have got a stake in it, so it has me
yeah,
covered for now.
super. And I mean, we have several news items still to go, but how about Unilever and banning the word normal?
Oh man, that's crazy. It's just crazy. We had a thread on Twitter about this and this new woke personality and all. Like, how can you ban the word normal? I just don't get it. I mean, as part of this marketing campaign, they have some merit to some of the stuff that they've done. So they are stopping editing, say, body shape, sizes, skin color, proportion, and trying to naturalize, people instead of grouping them together to perceive what normal would be. And I agree with that. We don't need to be brushing up people on Photoshop to make them look like supermodels, because that makes people feel depressed when they buy their products and it doesn't work. So that kind of side of it, I understand. But really banning the word normal, I mean, I'm going bald. I would love normal hair, but do you know what I mean? I just don't get it. I mean, I just shudder to think when my kids grow up in 20 years, what are we going to be allowed to say or not say anymore? I don't know.
I think we're getting too old for this
But
kind of stuff.
yeah, but they did call out, and it's really targeting the likes of the Generation Z. So it's more about them, and that generation are all about accepting beauty and owning their own imperfections. So I suppose they're trying to trade on that kind of quote unquote bandwagon, and trying to get in with the younger investors, and because essentially they're going to be people that will be buying their products longer, I suppose. So I can understand why they're taking some of the moves, but as I said, removing the word normal is a little bit excessive for me.
Yeah, I mean, I can't be too bothered about it. I understand the how you said, the emotion that it sparks in people to take the word, because there's, you know, there's so much going on in society with things that we are changing. You know, sometimes it's for the better, sometimes it's for the worst. But I wish the marketing department a lot of luck there with changing their vocabulary, because those will be the ones struggling, saying like, no, no, sorry, normal is also on the ban list. No,
And
this word you can also not use. No, no.
something just popped into my head, and I don't know if you remember, but were Unilever caught up in some scandal with an advert a couple of years ago? They were doing something with skin color, I believe. They
Yeah,
were peeling off
yeah,
the skin
yeah.
to reveal different colors. So maybe they've took a hard hit from that, and learned a little lesson, and kind of said, do you know what, we might play it a little bit more safe.
Well, you know, normal doesn't exist in that sense anyway. So maybe maybe it's just pure logic. But to put it in the media like that, I think it sounds more like a marketing statement than anything else. So I like the dividends, which are quite normal to me. So I hope I'm still allowed to say that.
No, I don't want normal dividends.
No,
I
no.
want
So
exceptional
then
dividends.
they're exceptional to me.
And I see you have some news then on one of my favorite companies at the moment. They're doing quite well for me, which is Royal Dutch Shell.
Yeah, the Ben van Beurden, the CEO, is taking a large pay cut again, and I think it's the second one in a row. And his pay cut, listen up, goes from 10 million to 7 million in 2020, or
Oh,
10 something. So it's a 42% pay cut. So I mean, you know, it's a nice example, right? If you had a bad year, that also your pay goes down. I remember the IBM CEO, after every bad year, the pay went up. So at least here, the pay goes also down. Quite some barrels of oil, I would say, down. But you know, what's also interesting that in the article itself, they will get. I think they're appointing a new chairman, the one that comes from BHP, Billiton from
oh,
Australia,
okay.
which is really interesting because I own shares in BHP as well. And this chairman will be tasked to find a replacement for Ben van der Beurden in the upcoming years. So they're starting to work on succession planning. So there's quite a lot going on in Shell, I believe. And yeah, I just find it interesting because you don't hear it so often that CEOs are earning less. I mean, he's still one of the richest CEOs, right? He probably still earns like, what is it, 40 to 100 times more than the average employee.
Yeah.
But you know, it could have been other news as well that he increased his salary of 40%. That's not uncommon to hear such things.
I mean, I'm sure the 3 million won't make too much of difference to his lifestyle, but it's really refreshing to hear a company do that. As you said with IBM, companies performing absolutely horribly, but they reward the CEO. So where's the incentive?
Yeah,
Whereas here we see, okay, we didn't perform as we should have, and we cut the dividends. So we've cut our shareholders, and now we're going to cut our top men as well. So I really like
yeah,
this. It's good. It's one of the reasons we love the structure of the company. I love that CEO as well. I mean, he probably came up with the idea, knowing him. He's a really top guy. So it's it's good, and one of the reasons why I love being invested with them.
yeah. Well, the perfect would have been if his salary was cut by the same amount as the dividend, like
Oh,
66%.
yeah,
Yeah.
yeah, that's true. Hey, send him a tweet. You know what'll happen.
He deserves to stay longer. Okay, two items left in the news that we found interesting. How about something around the football index?
Yeah, do you know what football index is, or have you
No,
ever heard of football index?
no.
So it was kind of built like a stock exchange for buying and selling football players. Have you got fantasy football over you pick a team
I'm
that
too old for this stuff, come
it's
on.
it's it's probably more of a Irish and English thing, but essentially what you can do is you can buy and sell players, right? And based on their performances, if they perform really good, they go up in value. If they perform really bad, they go down in value.
It's called Football Manager.
Yeah, sort of like that.
Yeah.
Except for this was advertised as a trading platform, and lots of people saw this as, and wrongly so, as more of like an investment type thing, because they never hid the fact that they were a gaming or a gambling platform. They never really hid it, but they did perceive themselves to be more like an investment vehicle, and people put lots of money in here because players were going up. Like, it was like the stock market, everything seemed to be going up. And what they did is, if a player scored a goal, got man of the match, they paid out dividends on these players. So it's like a bonus for them doing well. Last week, they announced that they are cutting them dividends drastically. So they were in huge financial trouble. Leading up to that point, they were playing it down that they were all rosy, that there was no financial trouble, and the CEO was coming out saying everything is good. But they were clearly in a lot of trouble, and the sustainability just wasn't there. The Gambling Commission have now come in and revoked their license, just taking away their gambling license. So you can't trade on that platform at the minute. They're likely going to go into administration. But it's quite sad, because I personally know a few people, and I've read a lot of stories on this, that people, they put in a small amount of money, seeing that it goes up, invest a lot of money, and then they tell their friends about it. I mean, this is a no-brainer. You make money, and lots of people are losing lots of money. Like, so, it's very risky and sad to see, but it's also a warning for investors, I suppose, that you really need to know what you're putting your
What you're
money into.
investing
Yeah,
in. Yeah,
yeah,
yeah. That's really interesting, and it's not in my circle of competence. I will probably never do it, but it's nice to see how things also get I said washed out a little bit after a crisis and such, and how
yeah.
you see like it puts certain stress on the certain dubious let's say companies and such.
I mean, they gave no indication that there was any bit of trouble, and they even sponsored some football teams in the English league. I think Queens Park Rangers and Nottingham Forest. So you wouldn't know. Honestly, I was looking at him a while ago, and thinking that it would be a good way to make money. I never went down that route, but I can see why lots of people got sucked into it.
Yeah, yeah. Okay. Oh, cool. So let's go then to the last news item of the week, and for me, this one is really interesting because the story continues, where we mentioned last week that Emmanuel Faber from Danone is resigning and will stay on as chairman. Well, his board might not really agree with that because one of the how you call it, the active investors, and the name of that is I forgot the name actually. But anyway, what is the case now? On Sunday they will have a board meeting without Faber to decide about his proposal, and it looks like it, if we need to believe the gossips from the newspaper Le Figaro in France, that he might not even have his chairman position left after this. So there's really going something on there in the boardroom, which is becoming really, I said, a popcorn story, I would say. It's amazing because if you look at Danone, I mean, it's a nice company, right? But the active investors are really, really having a lot of influence at the moment. And, I hope it's for the good, right?
Yeah, it seems like there's more of this story to be uncovered. Like, we mentioned how it was bizarre or strange that a French company, that a CEO of a French company has taken this, and now we're seeing pressure that he's not even going to be chairman. There has to be an underlying issue. It can't just be poor performance. There has to be something else.
Yeah.
So
Yeah. Yeah.
we'll wait and see.
Yeah, so every time I read something in news, I will keep bringing it up here in the podcast because this story continues. And Monday, maybe we will know more.
Is it having an effect on the share price?
Not from what I've noticed.
Yeah, I haven't checked this week, but I was just wondering how investors felt about it.
Okay, so let's then. I mean, this was a lot of news. I think a lot of news about the companies we own. Yeah,
Mm-hmm.
and these are not market-moving news items, but they say a little bit about the craziness in the world, I would say, and how it's potentially having an influence on our portfolio. But let's start with the main topic now. So, engineer my freedom. Why the heck did you sell Coca Cola?
So I remember I wrote a blog post on this, and it got quite a number of hits. And it seems like my Spanish community have disagreed with me on this, particularly Eli Snowball, who sent me a pleasant tweet actually with how he disagreed. But first of all, I want to say that I do think Coca Cola it is still a good company. It's a great brand, but I will kind of go through my reasoning and thought process and why I came to the decision of actually selling them. So I don't know if you know their CEO. They have a relatively new CEO, James Quincy, who has come in. I mean, Coca Cola are not really known as a company that's going to innovate. I mean, they've never really innovated a whole lot, and he's coming in. And to be fair to him, he's trying. He's trying to turn it around. He's investing in coffee with Coke. Costa Coffee obviously came in. They're releasing their first alcoholic drink, which is quite interesting. I personally believe they're too late to that market, that'll have absolutely no impact.
Vodka Cola?
Vodka Cola is a good name, but I can't remember the name of the brand. I did see the brand name, but I'm after forgetting it. But Vodka Cola is definitely better. And he's also trying to get rid of the dirt that they have, like Diet Coke, Cherry, and Zico, and all this kind of stuff. And he's more investing in Coca Cola energy drinks, and I think it's AHA sparkling water, and so on. So he's doing a pretty good job, and he's coming in and trying to get rid of all the crap and focus more on what works for them. But when I go through, I have my fundamental analysis tracker, and I put in 10 years worth of data, and I look at all the income statements, the balance sheet, and the free cash flow. And the first thing that sticks out is that revenue and earnings have declined over the 10 years. Now, revenue has been kind of flat. It's not taking a huge dip, but earnings is just not there. It is declining. The free cash flow is also growing at a faster pace than the dividend growth rate. So when I see earnings not growing and I see free cash flow growing at a slower pace than the dividend, that's an alarm bell for me. So I know they've increased their dividends for 48 years, but how long more can they do it if their dividend is outpacing what they're earning or what they're making in free cash flow? And just to put some figures on that, the revenue declined over 10 years by 3.38%, and over 5 years, which is 5.71%. Now, a lot of this has got to do with the refranchising of its bottle operations. And I've mentioned this in my blog post, and I think I said it last week. When you're going through the statement, there was lots of buying and selling, and it was really hard to follow where the money was going. But essentially what they're trying to do is just sell the bottling operations because it is more capital intensive and has a lower business margin than, say, their carbonated soft drinks. So it makes sense. But these structural changes have hit the net sales hard, and it's why we've seen a decline over the last few years. They did finish this restructuring process in 2018, I believe, and in 2019 we did see revenue start to grow slightly. But then obviously we have the coronavirus, we have 2020 where we have a dip again. We're still in lockdowns. I mean, over 50% of their revenue comes from out of the home, like in restaurants, bars, pubs, and all this. I mean, we're still in lockdown in Ireland and in most of Europe. So they're going to be hit hard again. again this year. So for me, the main reasons why I sold them is I think they're massively overvalued. So I don't think there's any value there at all. The balance sheet did not look too strong to me. They have a negative tangible book value. The goodwill on the balance sheet was like 82% of the equity. Debt to equity was 200%, and the debt to EBITDA was over 3. So even on the balance sheet alone, I wasn't too happy. The payout ratio is above 70%. Actually, averages 80% over the last 5 or 6 years. And as I said, the dividend growth rate outpaces earnings. So based on all that, it's typically the opposite of what I look for. So my fundamental analysis tracker rated them at, I have it here. It was pretty low actually. It was 20 or 17.5 in financial strength and 17 in dividend safety score. I know like the past is not always an indicator of the future, but it's not quite clear to me how much of an impact selling these bottling operations is going to have on their future growth at the moment.
Yeah. I think, it sounds to me a compelling case. I don't own Coca Cola, and actually I always shied away for that reason, what you mentioned. But what I do find really interesting is if I look at their free cash flow, it grew a little bit between 2019 and 2020, while their revenue declined with really a lot of, I think more than 10%, if I'm correct.
Yeah.
And this in one of the worst years for them, right? So how do you have you looked at the impact of COVID-19 on their free cash flow, and if the sales would have been normal, do you think that the free cash flow, for instance, would have been looking much better? Because the question here really is like, is the turnaround already kicking in, in the numbers, and is it just masked by 2020 COVID-19? Or is the turnaround not kicking in yet?
I would imagine that the free cash flow would have performed a little bit better if we had restaurants and pubs and like as we said, 50% of revenue out of home. It's a big portion of the revenue. So of course there would be an improvement. But then you have to look at Coca Cola. We spoke about Unilever earlier, and they're jumping on the trends. Jumping on Generation Z. Coca Cola to me are on the wrong end of the obesity trend. We know lots of the younger generation now are health conscious. There's lots of things about sugar tax coming in, regulations on this, and this is where they are heavily positioned at the moment. That's where I know they have options where they have sugar free and all this, but they're still. I would classify if I think of Coca Cola, I think of sugar, no matter what they market at the moment.
So you see it almost like a tobacco stock.
Yeah, essentially, and I think I think there'll be lots of people who have the same mindset, and it'll be hard for them to change that. They're slowly trying to change it. They are focusing on water and coffee and maybe alcohol to a certain extent, but they're still, to me, on the wrong side of that trend at the moment.
Yeah,
the growth might be there, and we might have already seen that turnaround in 2019. COVID is just really, really bad timing, so they're going to be hit last year and this year. I would prefer to get back into them maybe in 2022 or 2023 when I see that turnaround happening, when I get confirmation of that.
Yeah, and usually with these kind of numbers, you would also expect a higher dividend yield, and you would expect how is it lower valuations for this company.
Exactly. I think the valuation is crazy at the moment. I think I had them valued at around $30, and they're up around $50, $55 at the moment. So I think they will come down to a fair value. I believe they will. They would be interesting to me at around $30, maybe, but certainly not at that price. And remember, I bought these when I was following the dividend growth investor. I'm now analyzing my whole portfolio. I have an analysis that I follow, and it has a clear set of instructions, and I kind of follow. So I'm kind of weeding out my portfolio, but it doesn't mean I won't invest in them again in the future. It just means right now there's better opportunities out there for me.
Yeah, horse sense, I would say. Okay. Well, thank you, and thank you for clarifying that because Coca Cola is such a strong brand. You see that also in the community, right? And
Yeah,
it's good to I said clarify your thoughts a little bit more about why. And I think I'm with you on the health conscious consumer. I mean, Coca-Cola can do whatever they want, but if I remember correctly, when I looked into Costa Coffee, it was still like marginal in their earnings. So
yeah,
they need to sell a lot more coffee all around the world with Costa Coffee, almost Starbucks like, to for it to have a meaningful impact. So yeah.
yeah. Do you know what I actually find interesting? And we've spoke a lot about Intel, IBM, and now I've spoke about Coca Cola, and they're three iconic brands. Do you know what I mean? Like if
Yeah.
you invested in them 20, 30 years ago, you would have made a lot of money and great companies. And now we're coming to a point where all these companies are trying to pivot. They're in a period of time where what they were doing before is not going to work, and they have to change. And it's really interesting to see how these companies are changing, but also the investor mindset. A lot of people follow companies because of their name or their brand, but how much do they actually understand about what goes
Yeah.
in no deeper
Yeah.
the company like? So I find it really interesting, particularly on Twitter. I've got lots of lots of people saying I agree and selling, lots of people disagreeing,
Yeah.
and I find it really fascinating.
The question about these companies is like, what is the next catalyst?
Yes.
And if these, from what I've seen, let's say in the early 2000s, there was a globalization going on, entering the Asian markets and such, which gave really a lot of tailwinds, right? But what are the, that's globalization, that's scaling. But now the catalysts are usually around digital transformation and technological innovation. And this is where these companies are struggling because they have such strong routine-based processes. I mean, that's how it looks like from a distance. But
Mm,
it's hard to turn around. They are not like technology born, like the new PayPal's of this world and such.
exactly. Have you actually seen the new Coca Cola cans? Have you got them, the slender
The
ones?
small ones,
Yeah,
yeah, it sounds like the same money for less cola.
it's well, I believe they have 40% less calories, so they obviously have less volume in it, but they're still charging the same. That's genius. That look, they're getting the same money for for less product, and they can claim that they have 40% less calories. So I mean, that's genius. I still prefer the old cans, but I'm a creature of habit.
Yeah. Okay, good. Now let's. Thanks for sharing your story here. So let's
And
go to the.
thanks to Eli Snowball, because I mean, just because I write an article, I'm not stuck in that. I'm always open to questions and debate, and if I'm wrong and someone points out, I'm always happy to learn.
Okay. So let's go to the listeners' questions because you will like this question as well. From Phil, of course. Any companies in your portfolio or watch list that work in the field of blockchain?
IBM, yes, long IBM.
Yeah. So tell me about it. Do you own it for blockchain or?
I don't honestly, IBM is a similar story to Coca Cola for me. I invested following the dividend growth investor. It is on my list to actually go in and deep. I'm scared to do it because I know it's going to be horrendous, and I'll end up selling them. But I don't own them. I think Bank of America is another one actually for blockchain. If I remember, they have a crazy amount of patents open on blockchain. So that might be one, but I don't have anything specific in that field at the moment.
Me neither. What I so this question really relates to it must be a technology company that's otherwise putting the foundations in place, right? And
Hmm.
and then willing to charge for that.
Yeah,
But I think blockchain will really make the impact in the industries where there's a trust issue within the supply chain. And so just look around you, and I think trying to find niche players there that have the right consultancy skills to implement blockchain there, I think that's where will find the wealth here.
yes.
Okay. So the next question then is from Dividend about the chowder experiment and whether it had impacted my future investment decisions. So maybe for the listeners, I wrote a post the other day on my blog about how I plotted my portfolio according to the chowder rule. So the chowder rule is kind of a rule that quickly allows you, as a rule of thumb, to how to predict the total return of your investment, and it does this by looking at the 5-year average dividend growth rate from the last 5 years, plus the dividend yield. And if that is above 12, to say it in a simple way, then it says like, oh, you've got one that is growing quickly and still with a good yield. So it's kind of a valuation metric. So what I've done, I plotted my whole portfolio on there. And Dividend is now asking, am I going to change anything in my positions? So the first thing is why I'm doing this. I'm doing this because usually around May I do my spring cleaning. It's this kind of a habit. So every May I shuffle in my portfolio of stocks I don't want to have anymore or which I want to have more of. So yes, it has given me this insights, and this is, for instance, one of the reasons why I'm still thinking like, okay, what to do with ExxonMobil, what to do with Bayer, because Bayer cut its dividends. It's still for me a bit of a turnaround story, but specifically around ExxonMobil, because there's no growth really in the dividend. I mean, not a lot. The yield is good, but it's there, and the same I have with AT&T. So effectively, it put on the spotlight the high yielders, because it's not so much that there is limited growth. I don't see a catalyst, and that's my main issue with ExxonMobil. I don't see a catalyst forward. While I see this with Shell a little bit, yeah, but not with ExxonMobil. So that's, for instance, an example of a stock, and I've got 2-3 others that I'm considering. But I'm now going into the debt analysis. So what I'm now also going to do is I'm going to analyze all the debts, balance sheets of the company. I do this also once a year when the annual reports are out, to see like has something significantly changed, because what's important, we saw it last year, is the dividend safety, and a weak balance sheet is one of the first indicators of that the dividend will be under pressure for me. So yeah, so the question then is like, are you planning also something similar? That's what Dividend is asking.
I believe I need to get a clone of myself at the moment to get time to do all this stuff. I read your post, and I've seen, I think you put the chart on Twitter as well, and it's really fun to follow, and it seems like a very good exercise. So I probably will do it. I don't know when. I've been promising all sorts on Twitter at some point, and time just gets away with me. But it's an exercise I might do soon. I was laughing. You might have seen me laughing when you mentioned it highlighted tea, and then you started talking about you're going to do depth analysis, and I'm like, well,
tea, I will skip it. We've done that in the show already.
Yeah. But hey, if you listen to their CEO, they have a really strong balance sheet.
Yep, and lots of cash.
Lots of cash. Excellent.
Okay.
We have a question then from Peter, and he asked us. He liked what we did last week with the valuation metrics, so thank you. But he asked us if we can cover any of the efficiency metrics, like ROE, ROA, etc. What do we use, and we recommend any in particular.
Yeah, I actually, so if there's one from the examples that he mentioned, is return on equity. It's for me kind of the Buffett indicator. I studied Buffett's investment philosophy, so that's why it's always on my radar, the return on equity. But mostly I look at the return on invested capital, and that is higher more than the cost of capital. So that's one of for me most important efficiency metrics, because it shows that the company is creating value. The return on equity is sometimes quite tricky, and just look at a company like Starbucks. They have a negative equity. Remember that when we looked at the balance sheet?
Yeah.
So for me, that's a really, with all these buybacks in the world, it's really hard to sometimes to use the return on equity as a reliable indicator.
Yeah, I think I'm the same. I use return on equity a small bit. I use it again just to compare across across the industry. I don't make any big decisions based on it. It's just one of those metrics that's nice to know, and really that's the only one that I really look at.
Okay, super. So then the next question is from Sego Investor, and he asks, do you guys sell a company when it is overperforming in order to keep the balance of in your portfolio? And if yes, what is the criteria?
No, I don't.
No.
I don't. If you read trading books, right, and they always tell you to hold on to your winners. So I don't tend, if I buy a company, I hope to keep them for a long time, and that's, I don't really want to sell them.
So companies that I believe in, I won't sell. But if I suddenly have an overperformer which I don't believe in, I would sell it. So
Okay.
it's really about, it's more the question like, do I want this company in my portfolio still 10 years from now? And maybe it has mediocre performance after that, but then maybe the dividend can still grow. So and grow into the price that it has, right? The earnings also into the price. So no, I have this with Microsoft. I've got Microsoft that grew 4 or 5-fold. And I have been thinking sometimes, well, should I not, trim a little bit off and reallocate that money because also the yield is really low? But I thought like, no, I would be crazy. Microsoft is knocking it out of the park. It just became rather a growth stock than a dividend stock. But I know that the dividends will grow into it, and I'm just looking forward for increase like 10% to 15% dividend growth now every year because the company can do it. So
yeah, and another thing maybe to look at is the tax impact of that as well, because if I know from an Irish perspective, that's a taxable event for me, 33% in capital gains. So I really want to be minimizing the amount of tax that I pay. So it would not really be worth doing that for me.
Good point. But he also asked us about our thoughts on Rush, and I believe you did an analysis the other day on Rush.
I've done an analysis, and I've done it for that newsletter that I've mentioned earlier that I write for. I really like Rush as a company. I think we spoke about them on here before briefly. They have a really nice, I don't know, aura about them. They seem really employee orientated, really care about their customers, and I really like what they do. From a dividend perspective, they've increased their dividend in Swiss francs for the last 34 years, I believe, which is quite good. The dividend growth rate is quite well. But no, I like them. I recommend checking them out. I kind of estimated that there'll be a 5% annualized growth rate over the next 5 years with them, which is good enough for me. I think as the vaccines roll out, I think that we're going to start seeing them doing a little bit better than they have maybe then this year. But I would certainly recommend them. Yeah, they're a good company.
Cool.
My only issue actually with them is the currency impact. Is investing in Swiss francs, and that's why I don't have them in my portfolio. That's my only issue at the moment with them. It's a big issue for me.
Yeah. Okay. Good. So then we have the NL, which stands for Netherlands, I believe, dividend investor, and he asks us, how happy are we with being a dividend investor, and if we are not worried about the current volatility in the stock market. The volatility might even create opportunities to buy great companies at a lower price. So yeah, for me, a volatility is actually a blessing for two reasons. Why? I get to bigger chance on buying companies at a cheaper price, high quality companies. Second, with volatility, the put options are also more expensive, and if I sell them, I get more premium, and those premiums act as dividends for me. So I'm actually quite happy with volatility. I think the market is just crazy in general. If you look at all the different stats, if you want to have a bearish approach, or you will find so many statistics that will tell you the market is heavily overvalued. I would be happy if the market goes down 40, 50% in the next few weeks, because imagine Johnson & Johnson for such prices. And I don't need the money in the upcoming 20 years. I need the dividends to compound, but I don't need the capital, the principles. So yeah, I love the volatility.
Do you know what? This made me laugh because I've been seeing on Twitter again when I scroll maybe on my lunch break, buy the dip and all this kind of carry on this week. And I look at my portfolio and like my portfolio has been green all week. Where is
Yeah,
this dip? Where is this dip?
yeah.
It hasn't been for my boring blue chip dividend companies. It's more for
The
these
tech growth. Yeah,
overvalued growth
yeah,
companies at the moment. Um, but look, I like being a dividend investor. It's boring, as we said. I do scratch that itch. I've started investing in FX as I said, and maybe some option trading as well. But um, I love dividend investing. I don't have to worry. I don't look at the charts too much. I don't really care. As I said, it's really more about the dividend at the end of the day. So I'm happy if you need a bit of excitement. Dividend investing is not for you. But if you're old and boring like me, then go for it.
yeah. But isn't that the reason why we started a podcast as well?
Yeah.
Yeah, we're not bored anymore now. We have always something to do on the Friday night. Okay, we need to how is it? Move on. So we have the next question is from Tony 1 million Journey, and he asked, "When do you guys expect to become financially independent following your DGI strategy?" And this is the first time we got this question on the show after 39 episodes.
I am going to be financially independent in 9 years' time, based on
Wow.
this strategy alone. Yeah,
Yeah.
9 years.
So based on my strategy, it will be probably 7 years or something like that
Cool.
left. However, I might take I wouldn't mind in 3-4 years from now just taking a semi-retirement, and that I maybe try to earn some money via different income or just start working 20 hours a week. So I might play a little bit with that, but if I keep this journey like that, it's probably around 7 years from now. It could be 8, it could be 6.5. It depends on what the stock market does a little bit as well to my portfolio.
Yeah, cool. 6 years' time. That's awesome.
Yeah, count on 7. Okay, then the next question is from Joapen, and he asks, related to risks of a company, how do you track, assess, and review them?
I find the 10K is fairly good for that. To be fair, I think it's Dividend Wave that pointed this out to me only recently, or over the last dividend day. I think we had he pointed this out, and it's a good place to start because it does list all the different risks from a company point of view and also outside point of view. So it's a good place to start.
Yeah, I have the same annual report as well for the European companies. And on top of that, usually after I'm now for 4 or 5 years following the stock market, I feel that I'm getting a little bit of a more better feeling of risks associated. And Fred, if you see 3 companies in the same sector claiming future prospects, and you know that if you sum it up, the sum of the total of that would be like much more than the market share available, then you know that a few of those will be at risk. So, yeah.
Cool. So we have a question then from BI Investor, and he asks us about the CME Group. So he mentions that they're a dividend monster that increase their dividends every year, but they also pay an extra dividend, so a special dividend. And he is asking, should he calculate that in with his dividend yield, because it makes a big difference in his yield, his return.
So I don't do it. There's a reason why the company calls it a special yield. So I wouldn't do it. But if it's rather than a question of valuation. If the company is fairly valued, then why not? And then if you anticipate on this, that's nice. For me, it's the same as like when you're an employee and you start I say taking your bonus into consideration for as covering your living expenses. I don't do it. I'm more on the conservative side, but I know people that do it. Yeah, they count on that from a monthly income point of view.
Yeah, I had a quick look at the link that he sent, and they've paid this every year since 2012, I think, which is good. So they pay this. They have extra cash left over, and they paid it as an extra dividend. But I personally wouldn't include that in my calculation with the yield, because it is, as they say, an extra or a special dividend. It's not guaranteed. And for example, in 2008, 9, 10, and 11, they didn't pay it. They paid it in 2007, I think. So you're not guaranteed to get that. So I personally wouldn't include that in my own calculations.
Yeah. Okay, and then a really quick one. GP, he asked if there's a schedule site for European dividends similar to dividend data. So what he's looking for is dividend calendar. That's how I understand this.
Okay.
And yes, I think there is one. And this one is from our Spanish friend called Barón del Dividendo. And I will put the link in the description of this podcast, because he, when you go to his website, he has a menu item called Agenda, and you will find there the dividend payments from companies in March. You will, if you go there, you will see, of course, mainly American companies, because most European companies are paying out dividends in April and May. That's the reason. But that's the most complete calendar that I'm aware of, and I also know that one is not perfect, but most of the calendars are just not reliable in the American companies, because they do some data scraping, and it doesn't make a lot of sense when you look at it.
For our non-Spanish followers, just use Google Translate. I find it brilliant. I follow his blog, and I just use Google Translate, and it's perfect.
Yeah.
So the final question then today came from an email that we got from William Pritchard. And again, if anyone has any questions, feel free to send us an email at dividendtalk@gmail.com. But he was asking us about the dividend reinvestment plan for dividends during the pre-retirement phase. So he was asking me, do we use it, first of all? And if we do use it, would it be better to put them into one company, or would you just not use it and pool your money together and strengthen another position? So my take, and I did write back in an email on this, my take on this is, my broker, Figaro, doesn't offer drip reinvestment plans at the moment, so I don't avail of it. I can't avail of it. If I could avail of it, I probably would only use it for my tier 1 companies, because they are the companies that I'm most confident in, and they're the companies that I want the most amount of money in. Maybe my tier 2 companies might come into that, but certainly not tier 3 and tier 4. I would rather allocate those myself into different opportunities.
Yeah, so I have similar. I can do it for some Dutch companies at my Dutch broker, and that's where I've turned it on for the tier 1 and tier 2 companies indeed. So Ahold and Unilever are having this, and for the rest, usually in general for tier 3 and tier 4, I would probably use the dividends to add to the amount of purchasing new shares from the next investment, next monthly investment.
I love the way you have like Dutch brokers. We have Irish stockbrokers over here, and they cost an absolute fortune to invest in. It's just not even worth investing in. And there's a scandal recently with Davy Stockbroker, so it's our most popular one over here in Ireland. There was a huge scandal, and they're now up for sale. So we have to stick with the Gyro for the time being for our Dutch companies.
Nice. Okay, so we came to the end of the show. Lots of questions today, quite some news, but I hope that our listeners got quite some inspiration again. And EMF, like always, thank you again for this podcast. I really enjoy them. And to all the listeners, have a good weekend, and see you next time around.
Adios.